Imagine walking into a bank in 1965 with a steady paycheck, a good job, and perfect financial habits, and being told no simply because of what was between your legs. Not because of bad credit. Not because of missed payments. Not because you'd ever failed to pay a single bill in your life. Just because you were a woman, and a man wasn't standing next to you to vouch for your existence as a financial being. It sounds like something out of a dark satire, but for millions of American women, this was simply Tuesday. This was the system. And it stayed that way for a shockingly long time, well into the era of moon landings and rock concerts in a country that liked to think of itself as modern. To understand how something this absurd could persist for so long, you have to go back to the very idea of what a credit card even was when it first appeared. In the late 1950s, companies like Diners Club and American Express began issuing the first general-purpose charge cards, and almost immediately, the assumption baked into these products was that the cardholder was a man. Not because anyone sat down and wrote a rule that said women need not apply, at least not at first, but because the entire architecture of American finance had been built around a single premise for generations, the premise that a household had one economic head, and that head was male. Everything else, every form, every ledger, every underwriting decision, simply flowed downstream from that one assumption. So when a married woman wanted a credit card in the 1950s or 1960s, the bank didn't really see her as an individual applicant at all. They saw an extension of her husband. If she wanted a card, the easiest path, and often the only path, was to get what was called an authorized user card, tied entirely to her husband's account, under his name, under his credit history, under his control. She could spend on it, sure, but she owned nothing about that credit relationship. If her husband died, if he left her, if the marriage fell apart for any reason, that card and every bit of credit history attached to it could simply vanish, because legally and financially, it had never really been hers to begin with. Now, you might think, well, surely a single woman, an unmarried woman living independently, earning her own paycheck, could just apply on her own merit. And technically, she could apply. But here's where things get particularly infuriating. Banks routinely discounted a huge portion of a working woman's income when evaluating her application. It was shockingly common for lenders to count only 50% of a woman's salary toward her creditworthiness, based on the assumption that she would probably quit working once she got married, or once she had children, because that's simply what women were expected to do. Her income wasn't seen as reliable, wasn't seen as permanent, wasn't seen as something a bank could count on the way they counted on a man's paycheck. It didn't matter if she'd worked the same stable job for a decade. It didn't matter if she had no intention of ever quitting. The assumption was baked in, and there was very little a woman could do to argue her way out of it. And then there was the matter of the cosigner. Even a single woman with excellent credit, excellent income, and a spotless financial record could often be told that she needed a male cosigner, a father, a brother, sometimes even a family friend, simply to get approved. Think about how strange that really is. A woman with a perfect financial track record, needing a man with potentially far less financial stability to essentially guarantee that she, a grown adult, could be trusted to pay her own bills. It wasn't about actual risk. It was about a deeply held cultural belief that women were financial minors, permanently, regardless of age, regardless of income, regardless of how responsible they actually were. Perhaps the cruelest version of this system showed up for women who found themselves suddenly alone, either through divorce or the death of a spouse. A woman could have run a household for 20 years, managed a family budget, paid every mortgage payment and every utility bill on time, and the moment her husband was gone, all of that history could evaporate overnight. Because the credit had never technically belonged to her. It belonged to him, and by extension to the marriage, and once the marriage ended, so did her financial identity in the eyes of the bank. Widows in their 50s and 60s, women who had spent decades being the picture of financial responsibility, sometimes found themselves starting from absolute zero, treated like teenagers applying for their very first credit card, simply because the system had never bothered to record their contributions as anything other than an appendage to their husband's name. Divorced women faced an even harsher version of this reality. Not only might a woman lose access to joint credit accounts the moment a divorce was finalized, but any alimony or child support she received was often treated by lenders as unreliable income, not worth counting toward a credit application, even if the payments had been consistent for years. So a woman could be receiving steady, dependable financial support, and a bank would essentially shrug and say, that doesn't count, because it wasn't a paycheck from an employer, and because, once again, it involved money tied to her identity as someone's former wife rather than as an independent financial actor. For a long time, this entire system operated with almost no serious pushback, because for most of American history leading up to this point, financial independence for women simply wasn't treated as a right worth fighting for at a policy level. It existed underneath a much larger structure of assumptions that women worked temporarily before marriage, that their real economic role was inside the home, and that any money they touched was ultimately part of a household economy controlled by a husband. Credit policy wasn't really designed with cruelty in mind so much as it was designed with a kind of blind indifference, an entire industry that simply never stopped to ask whether its assumptions still matched reality, especially as more and more women entered the workforce throughout the 20th century and stayed there. But by the late 1960s and into the early 1970s, cracks were beginning to show, and not just quietly. The broader women's movement of that era was pushing hard against exactly this kind of institutional discrimination, and credit access became one of the clearest, most tangible examples of inequality that ordinary women across the country could point to and say, look, this is not fair, and this is not abstract. This affects my ability to buy a car, to rent an apartment, to get a mortgage, to build any kind of financial future of my own. Stories began circulating of professional women, doctors, lawyers, business owners, women earning substantial incomes, being denied credit outright or forced to jump through humiliating hoops that no man in their position would ever have faced. The absurdity of the system became harder and harder to defend publicly, even for the banks themselves. The turning point finally came in 1974, with the passage of the Equal Credit Opportunity Act. This piece of federal legislation made it illegal for creditors to discriminate against an applicant on the basis of sex or marital status. For the first time, a bank could not simply reject a woman's application because she was unmarried, or divorced, or widowed, or because a loan officer personally doubted that a woman's income deserved to be treated the same as a man's. It also outlawed the practice of automatically requiring a husband's signature on a married woman's application, and it prohibited lenders from discounting income simply because it came from a woman rather than a man. It was, in many ways, one of the quieter pieces of civil rights legislation from that era, overshadowed in public memory by bigger cultural moments, but its impact on the daily financial lives of American women was enormous. Even after the law passed, change didn't happen overnight. Old habits inside banking institutions took years to fully unwind, and plenty of women in the mid to late 1970s still had to push back against loan officers who were slow to update their assumptions, slow to stop asking for a husband's signature out of sheer institutional muscle memory. But the legal foundation had shifted, and for the first time, a woman denied credit on the basis of her sex had actual legal recourse, actual grounds to fight back, rather than simply being told that's just how it works. Looking back at this chapter of American financial history now, it's almost hard to believe how recent it really is. We're not talking about some distant Victorian era locked away in sepia-tone photographs. We're talking about the lifetimes of women who are still very much alive today, women who remember needing their father's signature to open a bank account of their own, women who remember being newly divorced and discovering that decades of responsible bill paying meant absolutely nothing to a loan officer once there was no husband's name attached to the file. It's a reminder that the conveniences we take for granted today, swiping a card, applying online in minutes, building a credit score entirely in your own name, were fought for, piece by piece, inside ordinary bank branches and courtrooms and congressional hearing rooms, by people who simply refuse to accept that financial independence should depend on your gender. And maybe that's the real lesson buried inside this piece of history. Progress rarely arrives as some single dramatic moment. It arrives through the slow accumulation of ordinary people refusing to be told no for reasons that never made sense in the first place, and through legislation that, while imperfect and slow to implement, finally forced an entire industry to look at half the population differently. The next time you pull a credit card out of your wallet without a second thought, it might be worth remembering just how recently that simple act was completely out of reach for so many women in this country, and how much quiet, determined effort it took to change that.